Hey family, welcome back to another episode of Elevate from Burnout to Bliss. I'm Reginald Clark, certified financial planner and your guide to all things wealth building, legacy, and financial freedom.
And I'm Ebony Clark, your friendly neighborhood tax accountant and strategist, here to make sure the IRS does not eat up your dreams.
I know that's right. Facts. Today is a heavy hitter, y'all. This is episode 10, Money Moves That Matter, What They Don't Teach You But Should.
We're diving into the real stuff, the kind of financial gems that most people never hear about unless they're in the right room.
That is definitely true. We're going to talk about how to build generational wealth for your children, the truth about life insurance, even the stuff that some agents don't understand, plus how to use traditional banks wisely and the money mistakes we see way too often.
We're also going to break down the pros and cons of self-directed IRAs, and then we're pulling back the curtains on business structures, because guess what? An LLC is not always the best choice.
We were going to talk about those so-called secret states like Nevada, why people talk about them and where they actually make sense for you.
So go ahead and grab your notepad, because this episode is packed with truth, strategy, and the kind of wisdom that can shift your whole financial future.
That's right. Let's jump right in. Money Moves That Matter starts right now.
So, Reggie, I'm really excited to share the information that we have for you all today. So when we talk about generational wealth, of course, the first thing that comes to my mind is our children and our children's children. So you mentioned in the intro about some accounts that can set them up.
Yeah, so as Ebony mentioned, we're gonna just get right into this part. So what I want you to do, if you have not already grabbed your notepad, you're gonna definitely want to do it really throughout this entire episode. Mm-hmm. And what I'm about to give you 3 accounts that you absolutely need to have if you want to build generational wealth for your children. The Bible says a righteous man leaves an inheritance to his children's children. It's more than one way to do that. All right. So here we go. 3 accounts that you absolutely must have if you want to build generational wealth for your children. The first of those is going to be a custodial Roth IRA.
Okay.
Custodial Roth IRA. And I'll break that down. The custodial part simply means that you or some other adult is going to be the decision maker for the account. Mm-hmm. The Roth part is where you can put it to an IRA that's after tax. It's going to grow tax-free, and if you do it right, you'll be able to take all the gains out tax-free at some point in the future.
Okay.
IRA is simply individual retirement account.
Okay. Now, say that again, but in simpler terms.
Which part?
When you explain in the custodial Roth IRA. So in a nutshell.
You're setting up a retirement account for your child before they even become 18.
Got it. Okay.
And and they're going to benefit from literally decades of compound interest. As a matter of fact, that was a great question, Evan. As a matter of fact, if you were to start this account for one of your children, or had you started, and again, you can start today. It don't matter how old they are. But let's just say a person started putting just $100 away a month, mm-hmm. right, when this child was first born.
Okay.
$100 a month, and they're going to do this for the next 18 years. And we're assuming that, let me throw something in there real quick. This is just illustration purposes. This is not speaking to a particular stock or anything of that nature, all right? This is just illustration.
Okay.
$100 a month, 18 years. Let's say they just get 6% a year.
Okay.
Nothing crazy. By the time this child is 18, mm-hmm. there'll be $37,000 put away. Okay. Matter of fact, $37,372. But watch this. Now that's interesting, right? Let's say you never put another dime in, mm-hmm. not another penny, you or the child, and you just let that 37 ride out till they turn 65.
Okay.
Again, with just that 6% interest, when that child turns 65, that account is now $577,992. Over $500,000.
That's crazy.
Just $100 a month, just for the first 18 years.
And what's that? 18 times 1,200, like 21,006?
Right. Plus the interest that you would have gotten, right?
That's crazy.
And then you let that ride out again for another 18 years. Till they turn 65. So the idea is, what people got to understand about compound interest. Here's the thing. Most people pay compound interest, mm-hmm. But put themselves in a spot where they only earn in, simple interest. But you want to earn compound interest. Mm-hmm. And when you ever do borrow money, you only want to pay simple interest. devote some other time to that. But just know this right here. Compound interest is when interest gains interest, that gains interest, it keeps going.
Wow.
All right? Interest on interest. Yeah, so that's the first of the accounts that you want to have for your child that you want to build wealth for. The second one is, now you got to make a decision over here because it's going to actually be one of two.
Okay.
A 529 college education plan or just a regular non-retirement brokerage account, custodial account, non-retirement. And the reason why I say you got to make a decision here, although they've expanded what a 529 college plan can be used for, the last tax code change did that, because now it can be used for K through 12. It doesn't have to be college.
Yeah.
They've expanded the definition of what it can be used for. It's still strictly for education. So, you know, they may or may not go to school, may get a full ride, blah, 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 blah. However, if you like a broader, now there's some tax benefits to go along with this particular account. However, if you want broader choices, then you may want to just do a non-retirement brokerage account, commonly called a UTMA. I want uniform transfer to minors. Don't worry about all that. Just a non-retirement custodial account. All right, that's the second. So either 529 or the custodial brokerage.
So we are sharing a lot of information today, and I want to make sure that everyone is with us.
Okay.
So you use the term brokerage account. Break that down.
I'm glad you did that. Brokerage account is simply an account that can hold stocks, bonds, mutual funds, exchange-traded funds, and things of that nature. All right. Don't let the word scare anybody. It's very simple to own. It's not nearly as complicated as it sounds, but I'm really glad you asked that question.
Okay.
And the third one, so the first one was the custodial Roth IRA. The second one was choose between a 529 plan and a non-retirement brokerage account. The third one is an absolute must.
Okay.
And that is life insurance, cash value life insurance for your child.
So how does that work?
Well, I tell you what, in later segment, I'm going to get to the deeper parts of it, but here's what I would tell you. You can own, you as the parent, can own the life insurance for the child. The kind is going to build cash and things like that. But with the plan of, now we pray to God you never have to use it, right?
Right.
The plan would be to transfer ownership to them when they become of age. It becomes a great, great transfer tool, that wealth transfer tool that would benefit them later. Now, I do want to jump back 1 second here.
Okay.
When we were talking about the custodial Roth IRA, here's something people got to remember. You're only supposed to contribute money to a Roth IRA if it's earned income. So the child technically supposed to have earned income. All right. And I know one of the things you're going to talk about is how children, especially if you're a business owner, can have earned income.
Listen, we can go ahead and talk about it now. So one of the benefits of being a business owner is that you can pay your children.
Okay.
So you're essentially transferring money from you to them, where it would be taxable on your end, but you could pay them up to $15,000 a year without it being taxable on their end. Now, the money, you do have to actually pay them.
Okay.
And the money that you pay them can't be used for anything that you're supposed to provide as a parent.
So you can't pay them and then charge them for the food.
Yeah, you can't charge them rent, none of those things. But if you have a retirement account or, as Reggie said, a custodial Roth IRA, the money that you pay them can be used to contribute to that Roth IRA.
Or the life insurance.
Or the life insurance or the 529. If they get allowances, that now they have their own money so they don't have to rely on you for an allowance. And you can do this for each of your children as long as they're old enough. They're minors and old enough to be able to actually perform some type of work or service.
So they could be in your office cleaning,
filing paperwork,
papers,
scanning, shredding,
taking out the garbage.
Yeah, and as long as it's reasonable for them to be able to perform those services.
And I think what's powerful about that is this is income that you were going to have to pay taxes on.
Exactly.
So you shifted or pay your children.
Right.
And then in turn, so now it's a tax deduction right there. And then in turn use that money to fund their accounts.
Because they are underneath the threshold.
Because so basically money, again, that you would have paid taxes on now, Uncle Sam is really enabling you to fund the accounts that you want to fund for them. Powerful stuff.
Definitely.
Very powerful stuff.
let's recap the 3 accounts to build generational wealth for your children: custodial Roth IRA, deciding between a 529 plan and basically a non-retirement brokerage account, and life insurance as a wealth transfer tool.
That's right.
So let's move on to the next topic: traditional banks. And what's the best use for a traditional bank?
Well, the best use for a traditional bank is really just for your transaction. When we talk about traditional bank, guys, I'm talking about, your neighborhood banks, Bank of America, Regions, or whoever it is you're using. So let me explain it like this. Mm-hmm. I do not store or warehouse large amounts of money in the bank.
Okay.
I just don't do it because that's not the best place to do that. The best use for traditional banks are for your transactions, paying your bills, having credit card access or what have you, things like that. But when it comes to building wealth, that's not what those banks are for. All right, that's just not what those institutions are for. They don't build wealth for you. They really build wealth for themselves, quite frankly.
Right.
But I see way too many people keeping large sums of money in the bank. And they give you a few benefits, like they may give you a certain status at the bank, or, you're in the private wealth banking or whatever the case may be. But at the end of the day, that is not the best place to keep large amounts of money. It's just not.
Okay. And I hear people debate about the difference between a national bank, a regional bank, and local credit unions. And now there are even online banks. So which is best? Or how do you know which bank you should use?
Well, me personally, I stay away from the online banks. I need to be able to see somebody about a problem. I
want to walk in a branch.
I need to be able to walk in a branch. I need to touch and feel you. I need to be able to do all that. Now, I will say that I'm partial to the community banks. You can build relationships with them. All their lending is not necessarily based off of some model, some score. You can build a rapport with them. Now, I will say, though, that they will typically have some limitations that some of the larger banks, so some things the larger banks can do, they can't do. So I have both. But I'm partial to the smaller community banks where I can get to know them, they can know me, and we can do business based on more than just a number or a model.
Yeah, that definitely makes a difference. A lot of things in business are about relationships.
It really is.
It's a lot easier to build a relationship with the local banker versus someone that you call an 800 number and talk to.
Absolutely. Definitely.
So in this first segment, we are just hitting various financial gems. So now let's talk about the biggest money mistakes people make. We were talking about this earlier, and I told Reggie we got to hit it.
Man, the biggest money mistakes grab your notepad. Here you go, y'all. I'm going to give you 3. I could go on and on. I could do a whole segment on this. I'm just going to give you the top 3 that came to my mind, or that come to my mind now. The biggest mistakes, money-wise, that I see people make. One, here's the first one, is having habitually bad credit. All right. This is going through life with less than perfect credit. Y'all, full disclosure, I've had bad credit. I used to offer credit repair as a service because I learned to repair my own credit. But once I put that behind me, I've moved forward, because going through life with bad credit is like running through life. It's like running a race with a parachute on your back. You're going to always be ice skating uphill. You're going to pay more for the same things your colleagues are buying for less. All right, because you've got to pay higher interest rates. So that's the first thing. 2, the second thing, a very bad money mistake, is not adjusting your expenses to your income. And what I see most people do, they say, okay, this is what I want to go spend. I got to figure out how to get more money. So they want to adjust their
income.
The income to their expenses. But you gotta. That's not the way to do that. You want to adopt the 30-70 rule. Meaning 30, you only learn to live off 70% of your money. Learn to support your lifestyle off of 70% of your income. And that way the other 30% can be used for saving, investing. If you return tithes and offering, things like that, right?
Wealth building.
But most people, use 110%, 120% of their income. That's what the debt and credit come in at.
And that leaves no room for emergencies.
It leaves no room for emergencies whatsoever. All right, so learn to focus on the expense side of your income statement. Again, I hear people say, if I just made an extra $500, if I just made an extra $1,000 a month, or if you learn to spend less. All right, it's the same thing. Saving money just like making money.
It is.
The third thing I see bad money mistakes people make is using credit or debt for non-durable consumer purchases. Don't get caught up in, if you don't understand what that is, don't worry about that. I'm finna tell you. Don't use credit or debt for things like food, going out, your clothes, your shoes, gasoline, personal care products. Stop financing things taking you 2 or 3 months to pay off that only took you 1 weekend to use. All right. You should never use credit or debt that's gonna take you longer to pay it off than it did to use it. All right.
Wow.
And people do that and they put themselves in a jam. Oftentimes they'll do it, like you said, for emergencies. But I see too many people living off of credit cards. Now, this is not the same as a person using a card for convenience. To rack up points, you're paying it off before the interest, the finance charge has a chance to hit. I'm not talking about that. I'm talking about the person that's living off of credit cards. All right. You are just setting yourself up for well, actually, you know what? You may go through your whole life like that, but you're never going to build wealth like that. I can guarantee it.
I want to go back for a second on spending. So when we talk about watching your spending, it's not about not spending.
Right.
You still enjoy the things that you want, but be intentional about it. Only spend money on the things that you purpose to spend money about.
That's a great point. Great point, Ebony. So guys, stay with us because coming up, we're going to be diving into business structure next and the smart moves that entrepreneurs have to make. So stay with us through this break. We'll be right back. Remember, it's time to elevate.
Today's episode is sponsored by P3 Financial Group, where we enrich the lives of our clients by helping them plan, protect, and prosper. Call P3 for all your tax and financial planning needs at 901-209-4015. That's 901-209-4015.
And we are back. Welcome back to the Elevate Podcast, where today we are talking about money moves that matter, what they don't teach you but should. So, Ebony, one of the things that I've heard, I see it all the time on social media when people putting out this content, is that when people are giving advice about starting a business, 9 times out of 10, they say people should always start with an LLC.
Right.
Let me hear your take on that.
So first, let's start with the basics about what actually is a business structure. So simply put, it's just legally organizing your business, right? So there are several types. There are 4 main types. We could get down into the weeds and talk about some others, but we're going to hit the 4 main types. Okay. The first one is the sole proprietorship. At the point that you are in business and you have not filled out a piece of paper, you are a sole proprietor. Okay. And that is an actual business structure. There's no formal paperwork, but you actually have a structure. You and your business are considered the same entity. Right. Okay. There's no separation between you and your business. There's no protection from legal matters, but you are in business. And because you're in business, you can deduct business expenses. So,
hold on.
Okay.
That's one thing. So I think some people miss that. So even as a sole proprietor, you can still deduct business expenses.
Yes.
You don't have to have a structure to do that.
Yes.
But it's just the other side of it, the liability side.
Exactly.
Gotcha. Okay.
So when you want to move from no liability protection to having some liability protection, then that's when you do an LLC, S Corp, or C Corporation. But first, we're going to talk about LLC. I do want to say there is not a tax difference between a sole proprietorship and an LLC.
Well, people, they spend that like it's just, the end all be all. Like it's, the tax magic books open up.
Right. No, there is. When you are filing your taxes, there is no difference in the form that you use when you have a sole proprietorship versus a single member LLC. It's completely the same.
Okay.
But what you have now done is created a line of separation between you and your business. So now there's liability protection.
Okay.
So Lord forbid you were to get sued, your business were to get sued, the person suing you would only have access to what your business owns and not any personal assets that you may own, as long as you're keeping everything separate.
So as long as that LLC is in good standing.
In good standing, you are not commingling funds.
Right.
They should not be able to get past what's called the corporate veil.
Okay.
Now, I did skip one. I do want to go back. When we talked about sole proprietorship, again, no formal paperwork. A sole proprietorship, sole meaning one person.
Uh-huh.
If you have that same structure and it's two or more people, then it's a partnership.
That's all a partnership is.
That's all a partnership is. It's like a sole proprietorship, but with more than one person. And again, there's no asset protection for that.
Okay.
So then we have the S corporation and the C corporation. Now, if we were to get technical, S corporation is really not a business structure. It's more like a tax election. So what that allows you to do is basically you have formed a different structure that allows you to earn some of your income from the business as a employee and some as an owner. So you would take distributions as an owner. So later on, I'm going to get into a different example explaining of how much you can save.
Okay.
But just know that an S corporation and C corporation, they are a different structure. But with those two structures, you do have to file a separate tax return.
Okay.
So
quick question. I saw a video very recently, as a matter of fact. Young lady was saying how you can become she said an employee of your own LLC.
You cannot be an employee of your own LLC.
Gotcha.
Because you
sound right.
and the LLC are the same.
Okay.
So at tax time, whatever the LLC makes, that's what you made.
Gotcha.
Whatever the LLC made, that's what you're paying taxes on. An LLC can have employees.
But you can't be one.
But you can't be one of them. But you can be an employee of your own S or C corporation. Got it? Okay. So just know that structure, your business structure affects everything from your taxes, liability, how you get paid. So you don't want to just wing it. You want to make sure that you're choosing the best structure for your business and know that LLC is not always the best choice. Okay. And it's not a stepping stone type thing. So you don't build up to the others. You determine which one is best and you go from there.
Gotcha. Okay, that all makes a lot of sense. And obviously I've heard you talk about these things before. Believe it or not, I'm actually sitting here taking notes as Ebony's talking myself. So here's a question I have. So when should a person or when should you form an LLC?
So a lot of times I'll get calls or questions and someone wants to start with the LLC.
Okay.
But they really don't even have a sound business idea yet. They don't have a sound business idea. They don't have a plan for how they're going to gather clients. They don't actually know when they're going to go live. So I don't recommend doing the official paperwork before you know those things. You don't even know when you're going to start making money. But as soon as you form an LLC, S Corp or C Corp, now the clock is ticking for those annual requirements that are needed to keep your business in good standing.
That makes sense. I think some people get excited about the idea of going into business and doing that paperwork gives them a sense of accomplishment. So that's why I think people are kind of rushing to that part of it.
Right.
And some other.
And I get it.
Yeah.
But we want to make sure that we're doing things in order and that it makes sense financially and from a time perspective. So some of the things to consider as far as a time frame on when you should start, when you start making consistent money, when you're working with clients or vendors under contract. So if you're working with clients or vendors under contract, then that opens you up for more liability than if you were at home, if you had a crochet business and you sold crocheted hats. It's not a whole lot of liability that goes along with that.
Right.
If you're taking on risk, so if you're coaching, consulting, if you're doing events, if you have a brick and mortar where people can come in and possibly slip and fall, those are things to consider. Also, when you want to build business credit, that's a good time to think about actually forming a legal structure.
check this out real quick. Y'all, this real story. I know someone who was given this, now listen to this advice, by their CPA. This person has a daycare.
Okay.
And the CPA told them to dissolve the C Corp
I wish y'all could see my face right now.
and put the daycare back into their personal name, sole prop.
Oh my goodness. That's horrible advice.
I thought so.
That's horrible advice. You're dealing with children.
You can't get much more liable.
Right. And now, Lord forbid something happens.
Yeah.
They can go after every single thing that you own.
I just couldn't for the life of me understand why that advice was given. So, Ebony, another thing that I hear people talk about a lot, I see a lot of videos about this, and that's forming a holding company, an operating company for different reasons or what have you. Talk to me about that. Like, what does it actually do when you got a holding company? Do people need these holding companies?
Sometimes people do need a holding company. Holding companies create layers.
Okay.
So if you are looking at your business and you want to make sure you have the ultimate asset protection, then you may want to have a operating company and a holding company. And usually those holding companies are in states or countries that have more stringent rules on how someone can sue you. Okay. So states like Delaware, Nevada, Wyoming.
Okay.
Their rules are a little more ticky. Someone has to work harder to sue you in those states. And then there's countries like St. Kitts and Nevis, and they have even more stringent rules for liability. But whenever I'm working with a client, I like simple.
Okay.
If you are 2 months into your business and you, let's say, give me a business that wouldn't require a lot of legal stuff going on. I can't think of one.
Maybe you make boxes, corrugated boxes.
You make corrugated boxes. Let's focus on the business first. Let's get a good, sound business structure, business plan, and make sure you're making money before we add in these layers. Because with each layer, there are other filing requirements, tax returns and things. And the last thing you want to do is have these layers to provide protection, but you didn't keep them up, so now you have zero protection.
Right, right.
Definitely don't want to do that, but there is a place for holding companies.
And you can come back and create the holding company after the corporate?
Yeah,
okay.
You can.
Yeah.
You can. You definitely can. I also want to hit S corporations, and I see on TikTok a lot of people talking about S corporations, and your business should be. The thing is, anytime someone gives you advice and it's a one size fits all, that's not advice.
Right.
It's not advice because it's not tailored to you. They're just...
That's information.
That's information.
Information
so
is
there's
different
not
from
a
advice.
one size fits all, but there are some benefits to an S corporation.
Mm-hmm.
So S corporations are considered pass-through entities. The entity itself does not pay taxes.
Okay.
But when your company is taxed as an S corporation, you have the option to make a portion of your money as a W-2 employee and a portion, like I was saying earlier, as a distribution from the profits of the company. So I'm going to use the quick example of if you had $100,000 in net income, your business did.
What's net income?
Net income is the money you have left after you got money in and paid all your bills.
So after you earned your money, paid all your bills, that's what's left over.
That's what's left over.
Okay.
As a sole prop or single member LLC, you are going to pay taxes on that whole $100,000.
Okay.
And you also have to pay FICA and Medicare on it. So that's another 15.3%. And you pay all of FICA and Medicare because there's not an employer paying half of it on your behalf.
Okay.
So in same example, but you're taxed as an S corp. Let's say you take $50,000 as a W-2 employee. So that part you're paying FICA and Medicare. The other $50,000 you're taking as a distribution. There's no FICA and Medicare on that. So in that example, you're saving $7,650. And the only requirement is making sure that what you get paid as a W-2 is reasonable for the services that you're providing for the business.
How do they determine that?
It's not a hard rule, but if the business profit at $100,000, you're not going to pay yourself 10 and get 90,000 in distribution. They know that you're doing that to circumvent taxes. So definitely want to look at whether S Corp is best for your business, but it's not a one size fits all.
That makes sense. So you mentioned it. I heard you mention Delaware. I heard you mention Nevada, Wyoming, that conversation. And you mentioned it's a little harder for people to go after you in these states. So does it make sense that everybody should be incorporated in those states?
No. Because another thing, when you incorporate in a state that you do not run your business in, that's more money that you have to spend because you have to have what's called a registered agent in that state. So a registered agent is someone that will receive official paperwork on your behalf. But it has to be someone in that state. And then if you do business in your home state, you're also going to have to register in your home state as a foreign entity. So you really need to work with someone and do it with the right timing and just make sure that it makes sense. If not, you're going to have 18 structures and you only made $10 and it just don't make sense.
Yeah, it just don't make sense at all.
And then some other things that you may not think about is just staying compliant, making sure you're doing your annual report, having an operating agreement. So an operating agreement is not something that you get when you form the business. It's something you create yourself. Okay. And that's just a document showing how you govern the business, who can sign on the bank account, things like that. And talk to somebody that knows what they're doing. Right.
Mm-hmm. Well, that's always good advice. Talk to people who know what they're doing. Because, just to kind of underscore what Ebony said earlier, I see the videos, the TikToks, the Instagrams, all the videos is giving all this quote unquote advice. But what I tell people is, like you just said, it's information. But you got to understand, most of these people are content creators.
Correct.
They don't do for a living what it is they're talking about. They create content for a living. I tell people all the time, I'm a financial planner that creates content. I'm not a content creator that gives financial advice.
Right.
There's a complete difference. All right.
And it is a difference. And you want to know that whoever you're receiving advice from has done it.
Right.
And how do they make money? That's the key. Right. How do they make money? So if you make money as a financial planner and you have content, I'm more likely to listen to you than someone that makes money as a content creator talking about financial planning and may not be licensed.
Right. Because, the thing about it is I can't compete with the content creator because while they are creating content, I'm meeting with clients. So from a time perspective, I can't pump out the same number of videos.
And
neither do I try. But I'm just
you're governed on what you can say.
Oh, ain't no doubt about it. I have to be careful, even in these environments, even on this podcast, I got to be careful what it is I actually say to the general public. Because again, it's not advice, it's information. So
yeah, well, we're going to close out this segment, and coming up, we're going to talk about life insurance and dive deep into the types of life insurance and what's best for you.
All right, stay with us, guys. It's time to elevate.
Hey, Elevate fam. Are you a business or brand looking to get in front of an audience that's all about leveling up in life, business, and mindset? Then let's partner up. The Elevate podcast is now accepting sponsors. That means you can get your brand heard by a growing community of go-getters, creatives, and purpose-driven listeners right here on the show. Whether it's a product shout-out, an ad spot, or a custom collaboration, we've got options for you. Want in? Hit us up at elevatenowtraining.com. Let's elevate together. We're back. If you're just joining us, this is the Elevate podcast from Burnout to Bliss, and today's episode is about money moves that matter. So we are about to drop some truth bombs about life insurance. Reggie, what are some common myths and questions that you get about life insurance?
Well, one of the main myths that I get about life insurance, I hear people say that's just erroneous, and that is, and I want to set the stage for this. Most people don't understand the difference between term life insurance and whole life.
Okay.
So the myth is, that I hear people talk about, is that term life insurance is better than whole life. Mm-hmm. Right? Or now here's another myth. I hear people say that whole life insurance is better than term. Mm-hmm. Both of those are erroneous, and both of those are a myth.
Okay.
Now, how could you say both are? Well, it's simply because life insurance, whether it's term or whole life, is just a financial tool. All right? That's what you got to understand, guys. It's just a financial tool. That would be like a carpenter saying that a screwdriver is better than a hammer.
They just have different purposes.
They have different purposes. And a financial professional should know the difference. Now, I can understand if this is not what you do for a living, I'll give you some grace on that. But whenever I hear someone who's supposed to be a colleague of mine say this, it really gets under my skin. All right, because term, and so I'll break down the differences between the two. Term life insurance, as the name implies, is a policy where the life insurance or the benefit lasts for a specific amount of time, a specific term.
Okay.
That's going to be 10 years, 15, 20, 25, 30, so on and so forth. Now, the policy itself can continue beyond that time. However, the rate is locked in for that particular time frame. If it's a 10-year policy, that rate's going to be locked in for 10 years. That 11th year, that rate's going to jump a whole lot, all right?
Are there any policies that are longer than 30 years?
No.
Okay.
I haven't seen any longer than that. Not where you can lock that rate in for that. And I'll also tell you that term is less expensive because it typically only comes with two benefits. That's the death benefit and the living benefits. And the living benefits, that's where you can use the insurance to offset long-term care costs and things like that. That's usually the only two benefits you're going to get with a term policy, okay?
And just to be clear, the death benefit is what people get when the person who is insured dies.
Correct. Yes, the actual insurance part of it. That's pretty much all you're going to get with term. Now, there are situations, and I'm gonna give you one. I can give you more than one, but there's all situations where term is a better fit, a better financial tool, and that is when you have a temporary insurance need.
Okay.
For instance, me and Joe Blow go into business together. We take out a 10-year business loan. We want to be sure if either one of us dies, this doesn't, the business can keep moving. Let's get a 10-year policy to pay off this 10-year loan.
Got it.
Or maybe you want to be sure that the house is paid when you're gone. It's a 15-year mortgage. Let's get a 15-year term policy to pay off this 15-year mortgage.
You used to hear about mortgage policies all the time, and you don't really hear about them anymore.
You don't hear about them as much. They're still out there. You see about this thing called decrease term, which I never thought made a lot of sense, but they're still out there.
But it's really essentially just a term policy for the same length of time as the mortgage.
That's it. Same length of time as the mortgage. Usually, the insured can get it with minimal underwriting if you just purchased a home. Usually. So, again, term is not best. So, whole life was, now, one thing about term, it's an expense. It's an expense. Whereas whole life insurance, because it's an asset, is completely different.
Okay.
It's completely different. So, what whole life does, whole life is a special part of the tax code that allows people to put money in life insurance as a cash saving vehicle, and life insurance comes along with it. All right. So, people say, well, it costs more. Well, because you are purchasing an asset. All right. It's not an expense. So you put money into the policy, it's going to give you the death benefits, it's going to give you the living benefits, but it's also going to be able to do a lot more things that I can't quite cover all in this little time that we have. But that cash, if it's structured properly, and we'll talk about that, if it's structured properly, that cash will grow inside the policy. It will grow tax deferred, not tax free.
Okay.
I'm going to clear up another myth in just a second. It'll grow tax deferred. And if you do it right, you can get the gains out tax free.
So do all whole life policies have a cash value portion of it?
Yes, they do.
Okay.
But not all whole life policies are created the same, because all whole life policies, cash growth is not based on the same thing. Here's what I mean. If the growth of that cash is based on a fixed interest rate, that's typically going to be what we call universal life. If the growth of that cash is based on dividends, meaning the profits of the company, that's traditional whole life. You usually get that from a mutual company. If the growth of that cash is based on a stock market index that's indexed universal life, or if it's based directly on the stock market performance, that's variable universal life.
So based on the policy, the cash is not going to grow the same. It's based on the policy, the company, I would imagine.
Yes.
And I would imagine that there are policies that are built specifically for this. So some perform better than others.
No doubt about it. So depending on what you need to do. So when people talk about buying, life insurance, especially when you talk about doing it for cash accumulation, you have to match up the right company, the right type of policy. You got to structure that thing right. It is 100% not a one size, one company, one type of policy fits all situations. 100%.
Just like with anything else, things get better over time.
Right.
So there used to be a time where with life insurance policies, all you got was the death benefit. And there was then cash value, but there weren't any living benefits associated with it. And unfortunately, in our community, people be like, I don't want to leave. Some people, not everybody, will say they don't want to leave their loved ones anything. But there are some living benefits with life insurance, too. Can you talk about those?
Yes, absolutely. But I want to say something about what you just said first. And I have actually done this. If a person tells me that I don't want to leave anybody anything, then I will let them know you're not someone I want to work with.
Right.
Because I look at it completely different. And I thought values it doesn't align there. Because life insurance is the last love letter you'll ever leave to your family. Right. And if you don't want to write that letter out, then you and I, we just different.
We have different family values.
We got different values. So if that's not your thing, then I'm not your guy. But anyway, for those who, wanted to, so Ev asked about living benefits. So the living benefits, this is where you can use a portion of the insurance part that can pay for things while you're still alive. Again, long-term care. If you can't perform 2 of the 6 activities of daily living, meaning you got to go into a facility, or maybe you need a nurse to come into your home to take care of you, you can actually use a portion of the death benefit to offset those costs while you're still alive.
Wow.
And another thing you can do, too, I've seen, and I've only had one client in all my years to do this, you can use the insurance if, God forbid, you're diagnosed as terminal. You can use up to about 90% of the insurance amount while you're still living. And I had a client, she actually took her niece on a round the world trip. She was, unfortunately, she was diagnosed with terminal cancer. She got to see the gift that she was giving her niece. And it was a beautiful thing. That part of it was beautiful.
Right.
All right. But let me clear up something else. What I want to talk about, what I said, one of the things that a lot of, again, agents don't know. I hear people say all the time, you can get money out of whole life tax-free. The cash is tax-free.
Yeah, I've heard that too.
That is a blanket statement that is chock full of assumptions and errors. Money that grows inside life insurance does grow tax-deferred, tax-free. Well, that's the difference between deferred and free. Here's the if. If you do a withdrawal from a policy and you withdraw more than you've put in the policy, because eventually these policies will have more money available than what you actually put in yourself. If you do a withdrawal, for instance, you put $20,000 in over time, you'll be able to take out $40,000. You're going to get a 1099-R that's taxable that say, hey, you owe taxes on the gains out of this policy. So now you're looking at your agent crazy like, I thought you said I could do this tax-free. The way to get the money out of the policy without paying taxes on the gains is to do it as a policy loan. Use it as collateral. Uncle Sam does not tax loans. All right, now, there's even an if to that. Because what you must do, that policy must remain in force.
Yes.
Because if it's ever surrendered prematurely, lapses or anything like that, then everything you got out above what you put in, even as a loan, will still go back and be coded as a taxable withdrawal.
The bottom line is, for all of these financial matters, there are nuances. There are benefits to various financial products and tax structures and tax strategies, but there are nuances to it. So if there's a blanket statement, in the end, it may be true, but there are things that you're going to have to do in the meantime to make sure that it's done right. So just make sure that you're doing your homework, you're talking to someone who's a professional to make sure that you're not 5 years down the road and realize, dang it, if I just filled out this form a different way, then I would have gotten the benefits, but now I owe.
Exactly. One more thing I want to say on life insurance, a couple more things before we move on. Here's a stat a lot of people don't know. This is an industry-wide stat I'm about to give you. Term life insurance has a 98% chance of not being enforced when you pass.
Wow.
All right. Let me say it a different way. If the only coverage you got in your life is term life, there's only a 2% chance that policy is going to still be active when you die. So life insurance companies love for you to buy term because they know it's a 98% chance they'll never have to pay out.
Wow.
So when it comes to covering your whole life, then you probably want a whole life policy.
So excellent point. What about when people have insurance just through their job? Like when we have insurance through our job, where does that fall in your financial plan and your financial picture?
If you only have it, great question. If you only have insurance through your job, I want you to look at that as 100% extra. All right. Sometimes jobs change. Sometimes you leave a job. Sometimes the job leaves you. All right. So it's just like having a company car. You can use it while you're there, but when you leave, you got to get that car back.
You sure do.
That's how I want you to look at life insurance through your job. So it's very important to have your own coverage that you're paying for, that you actually own.
Man, that's some great information. So we talked about life insurance. Now, I keep seeing on TikTok and people are asking me questions. We're going to change courses a little bit about self-directed IRAs. Can you let us know what those are and kind of clear up some things?
Absolutely. Yeah, Ebony, I hear that a lot too about questions about self-directed IRAs. I do want to take a second. Let me first define what a self-directed IRA is. And it's simply an individual retirement account that empowers you to diversify your portfolio with alternative investments. Typically, and what I mean by that is beyond regular stock market, stocks, bonds, and things of that nature. Because inside of a self-directed IRA, you can actually hold things like cryptocurrency. You can put real estate in there. You can put coins in there, precious metals, businesses you can put in there. So it's things you can do that you can invest your money in a self-directed IRA that you just simply cannot do with a regular brokerage account. Right? So, and for that reason, I see a lot of advertisement around the attractiveness of the different things you can. For instance, why buy real estate in your own name when you can buy it in your IRA? All right.
Right.
There's a lot of reasons why you may or may not want to do that, but if we have time, I'll get to some of those. One of the things that I would hope the listeners can get out of this segment right here, when this type of IRA, self-directed, puts a lot of responsibility on the IRA holder.
A whole lot.
That a regular IRA does not. All right. So one of those things is going to be you have to get those assets valued. Those values have to be sent. The custodian, they have to send to the IRS, all those things. Because each year, the IRS has to know the value of what's in your IRA. All right. If it's real estate, that may involve appraisals and things of that nature every year. There's a lack of liquidity sometimes with the assets you hold in an IRA. If you may remember when the gentleman came to us to help him unwind his IRA, he had precious metals in it.
It took over a year for us to unwind it. And the key is that these things work, but they're not as simple as people tend to make them out to be. Like all that glitters is not gold. Yeah,
and I'll say real quickly, we didn't set it up. He came to us to unset it.
Yeah, to dissolve it. And it's a complicated process to get self-directed IRA dissolved because those funds are still under the general IRA rules.
Yep.
So just do your homework and make sure that you understand all of what goes into it.
Yep. There's also a greater potential for fraud, and they have much higher and more complicated fees. Real quick, one of the reasons why I don't like putting real estate inside IRAs is because if I hold it individually, I would potentially pay capital gains, which is less taxes than if I put in an IRA. I may have to get it taxed at ordinary income.
That's true.
Yeah. So anyway, want to be careful about using self-directed IRAs. I would say 100% proceed with caution. Guys, this episode has flown by.
We're done?
We're done already.
Oh, my goodness.
Y'all, you can find me if you need us. I hope this information has been great at The Money Jedi, on Facebook at Money Jedi. Ebony, where can they find you?
You can find me on all social media channels at Eb the Advisor, EBTHEADVISOR.
And you can reach both of us at 901 209-4015. As always, it is time to elevate.
Today's episode is sponsored by P3 Financial Group, where we enrich the lives of our clients by helping them plan, protect, and prosper. Call P3 for all your tax and financial planning needs at 901-209-4015. That's 901-209-4015.